Ladies and gentlemen, I now invite Ms. Smitha Hari, President, auctusESG, to enlighten us on climate transition and transition finance. Ms. Smitha Hari is a finance professional with 18 years of experience across corporate banking, investment banking, sustainable finance, ESG, and impact investing. She holds certification in sustainability and climate risk from GAP. Her last role was with the corporate banking vertical of a large private sector bank as part of the impact investing team. She specializes in product structuring, financial analysis, and research. She currently leads the India operations at auctusESG. Over to you, ma'am.
Okay, so while the deck comes on, good afternoon, good morning, good afternoon, everybody. And I think a lot has been told about climate since the morning, and a lot more to come. But over the next 10-15 minutes or so, I'd like to talk a little bit beyond green, to talk about climate transition, what this means for banks. And at Auctus, the company I represent, so we are a global sustainable finance, ESG, and climate transition advisory firm, and we work a lot with financial institutions across emerging markets on these issues. Okay, thanks. So if you move on to the next slide. So I will basically want to give you an overview of, you'll manage it? Okay. Start off with a little bit around climate risks just to set the context, and then move into, the transition planning, why it's important for banks, and then looking at it from an opportunities lens to speak of transition finance, some products, what are the elements for a bank, and some case studies. Can we move to the next slide? So just to set some context, now I know this is like preaching to the choir and everybody knows about this, but it's always good to reiterate these issues given the gravity of what we are facing today. So the annual World Economic Forum Global Risks Report has highlighted, 2023 report has highlighted 5 out of the 6 risks to be climate or environment related. And just to throw in some numbers, in 2022, about 300 disasters, natural disasters globally, $300 billion of damage. Zoom into India, again, the numbers don't look good. Obviously, we know the kind of physical events which have happened as latest as December when Chennai was flooded and the amount of damage that has caused. So what this all means to banks. So there was a study which World Bank had conducted in Philippines, in the Philippines banking sector, and what they found was for a 1% point increase in the typhoon damage incidents, this translated to a 2.3% increase in the NPA ratios for banks. So this is quite a large number. So given the gravity of situation, it's not no longer banks can ignore these kind of aspects, and climate risk management therefore becomes very imperative when we talk of banks. So just looking at how this actually translates to banking risks in the form of transmission channels. So we all know that physical risks, transition risks, which are getting increasingly pertinent in the economy, how that translates it's in the form of loss to damaging physical assets, disruption in business continuity, affecting household incomes, all this translating to debt serviceability being affected. Again, this is not just restricted to credit risks, but also other conventional risks of banks, so market risk, operational risk, looking at liquidity risks, and so basically all risks of banks. And one must not forget the negative feedback loops which can happen. So if a sector is affected by climate risks and therefore banks or financial institutions in general withdraw credit, then there is a negative loop which goes into it because it affects the mitigation, adaptation capacity of the sector itself, which kind of compounds the whole issue. Therefore, it would be a good time for banks to look at it with micro lens from sector perspective, geographical perspective, on which are the pockets which are most prone to climate risks and therefore prioritize their action. Some perspective around policy, regulatory developments in this space. So globally, there has been a lot of action especially in the last half a decade or so, GFANS, NGFS, of which RBI is also a part of, the IFRS coming out with ISSB, the International Sustainability Standards Board, which specifically talk of climate and sustainability and climate related disclosures. Basel has come out last year with the principles for climate related risks in 2022, not last year, sorry. So basically there is a lot of action happening globally around this from a regulatory perspective. Also at a country level, so not just restricted to European countries, but also in other markets, like for example in Asia, we have Singapore, Malaysia, which have come out with climate risk management requirements, banks, central banks as well as monetary authorities. And RBI is also, we've heard a lot from RBI from starting off with the climate risk discussion paper, which came out a year and a half back, and then subsequently what followed through. The last year's currency and finance report, in fact, in some way was set the tone for the whole climate risk discussion, where the Indian bank's transition risk exposure was kind of, highlighted very clearly. So just wanted to indicate on how the regulatory landscape is evolving around this, and as a result, if you just trace back the events which have happened in this space, we all know the Paris Agreement kind of increased the focus around climate discussions. And a couple of points I wanted to highlight here is one of the IPCC reports, which provides relevant information which shapes policy making. These are science-backed informations. And the global stocktakes, which is basically a process to evaluate how countries are performing on their climate targets, commitments, etc. And the first global stocktake was started in 2022, concluded last year at the COP, the recent COP, and the initial findings are not good, which basically indicate that countries are not on track and a lot more needs to be done to kind of push the pedal on these aspects. And one final point is around NDCs and how they kind of correlate to the financing, climate financing we've been talking about since morning. So the targets put out by countries actually translate to how these can be financed, and aligning with NDCs therefore is a huge financing opportunity for the financial sector. So we all know what India's NDCs are, which was initially commented upon in 2015 and then updated at Glasgow in 2021. But analyzing the implications of NDCs, from what could be the potential stranded assets in the books of banks, and therefore planning your portfolios accordingly would be quite important, which kind of directly links the relevance. And like I told you in the earlier slide, NDCs also present opportunities. So if you look at the NDCs, large focus around renewable energy and the clean energy targets, and therefore there is a likelihood of doubling capacity over the next 10 years or so, and this presents a visible opportunity for banks to look at specifically look at such sectors. And even if you look at government policies which have been focusing in India on renewable energy, on e-mobility, and then tapping into these sectors. So we've seen most banks already have exposures in these sectors and are increasing as well. So this brings me to the next topic around transition planning, on why transition planning is important for banks. So obviously the changing regulatory landscape around the world, and which is also translating in India, is an important factor. But we've seen that there have been piecemeal approaches towards this, addressing few aspects of transition. But recognizing the risk of delayed transition. So IMF in 2023 told that the more there is a delay in transition, the graver will be impacts, and there will be a lot more to be done from a financing angle to kind of catch up. And recognizing this, there have been central banks across the world who have pushed the pedal on transition as a subject. And that's one aspect, but also from the investor's angle, especially where financial institutions are raising capital, or companies are raising capital from across borders, this has become an important topic of discussion. So pushing banks to look at what they are financing, how they are financing, and what is the pathway to kind of, change the portfolios. What one needs to also think of is, the bigger reason is, of course, the double materiality which is faced. So the impact of climate-related risks on banks' books, and simultaneously the impact of the lending, on the lending on the climate, on externally on climate. So in short, banks can neither ignore the climate-related risks to their own portfolio, nor what the effect is around what they are financing. So therefore, an approach which kind of addresses both is kind of becoming more and more relevant, again backed by what regulators are saying and investors are demanding. So how does one go about this transition planning? So this topic is very vast and we can talk the whole day on it, but just to touch upon the steps very broadly. So we know that the major sources of GHG emissions are from the real economy. Banks by themselves don't emit that much, but as providers of capital, that is where the huge impact comes from financed emissions, and I believe the next session will talk a little more detail on that. But the first step towards the decarbonization journey, therefore, would be to look at where your financing is, what is the kind of emissions it is generating. And after that, looking at, transition is a sector topic, we all know that, right? So looking at sector-specific actions, sector-specific requirements based on sectoral pathways to get there, and thereby looking at how you can set your targets, your climate ambitions, and then breaking it down to interim targets. So if I'm going to have a net zero target of 2050, then how does that translate to a 2030 target or a 2040 target in terms of my portfolios, would be how one would go about it. And again, using science-based scenarios, this is what most international bodies have also stressed on. I'll talk about that in a couple of slides, on using science-based, science-backed theories and science-based scenarios. And finally, to look at how to conduct annual reviews around the targets, around the ambitions put out there from a reporting standpoint. So building that credible transition plan and reporting that would be the crux of basically disclosing how you are going down this transition journey. And all this backed by the product strategy, basically looking at your product's perspective. So looking at your existing product stack, financial product stack, and how you can build in innovations from a climate standpoint, as well as on policies. So banks have internal policies, and I'm sure most banks, in Indian banks also have exclusion lists. So similarly, internal policies on how to kind of look at hard to abate sectors. So having said this, we've spoken a lot about the risks, but there is a lot of opportunity as well embedded within the transition because of climate transition, and the earlier panel also touched upon that a lot. So across sectors and across subsectors as well. So IFC estimates about $3 trillion to be the opportunity in India. CEW has put out a $10 trillion number to finance net zero goals, the 2070 net zero target. So banks being at the forefront of providing this capital can really capitalize on this opportunity. And our interaction has been with banks have seen that there are new sectors which are highly risk prone, and therefore there is a hesitance to kind of finance these sectors. But looking at it from innovative financing models, how you can bring in credit enhancement mechanisms can push the pedal on this. And I believe a couple of sessions down the line we'll be able to look at that a little more in detail, so I'm not getting into that right now. And so this, the opportunity side brings me to the next topic around transition finance. Again, the topic itself is evolving, new, so different definitions by different entities. But how do you finance the transition from brown to green? Not directly, but brown to less brown to green. That is essentially the transition finance. And for countries like India and many other emerging economies, it may not be possible to go directly from brown to green. Therefore, financing that mid pathway where you can actually transition from brown to a less brown to a green kind of a scenario is what transition finance essentially is. And there are a lot of international guidelines, frameworks around this topic. So climate bonds initiatives, financing credible transitions paper talks a lot about what are the principles to be in place, which I was talking to you about having science-based targets. So this is what climate bonds in the paper stresses upon this. And ICMA has also put out a transition finance handbook in 2023, June 2023, which again talks about what issuers of transition products should do in terms of what is it that they should follow. So in India as well, SEBI, when it expanded the definition of green debt security last year in Feb 2023, they brought out the definition of transition bond, and further in May 2023, enhanced this in terms of what should be the disclosure requirements when an issuer is coming out with a transition bond. So there's a lot of action happening around this both globally and has started percolating down in India as well. This is where taxonomies become very important, because having a definition of what is transition kind of becomes very relevant. So globally, taxonomies have thus far focused on the green aspects, but now the last couple of versions which have come out, so for example, the ASEAN taxonomies V2, the version 2 taxonomy kind of spoke a lot about transition, and Singapore's taxonomy also talks about transition. So from a product perspective, again, we look at sustainability linked loans, sustainability linked bonds, which are at entity level. So talking about entity level transition. And transition bonds are those which, talk of use of proceeds. They are use of proceeds instruments, which are not at an entity level, but more looking at specific transition initiatives within the brown sectors. And the transition bond space is still very nascent, minuscule, but 3x growth has been witnessed according to a climate bonds report. And this is the only segment which has kind of witnessed a growth. So encouraging signs there. And from a bank's perspective, again, when you go down the path of transition finance, more a repetition of what we've spoken so far. So having an internal taxonomy, tagging your assets from a transition perspective, that will kind of help you in bucketing your loans on what constitute transition. And again, innovating the products and having engaging with stakeholders to kind of scale these offerings become very relevant. And this is a little bit about just a couple of products which are out there from a transition perspective. So the first one is around in Japan, where Mizuho Bank came out with a transition-linked loan for a transportation company. Again, these are linked to sustainability targets which are put out, and the interest rates either go up or down based on achievement of targets. And similarly, the ADB loan, which was for the agri sector, also had targets which kind of went up. The interest rates move up or down depending on achievement of targets. So these are basically focusing on transition climate transition aspects. So with that, I've come to the end of the session and hope this was kind of useful. Thanks a lot.
Thank you very much, ma'am. Can you wait back for a second, please? Chandrasekhar sir, may I invite you to present a memento to Smitha madam? Thank you, ma'am.